Have you ever thought about how easily you can turn your stuff into cash? Not just dollar bills in your wallet, but everything you own. That's what we're talking about today, liquidity. It's a surprisingly important concept, not just for investors, but for everyday financial health. So, what is liquidity? Simply put, it's how quickly you can convert an asset into cash without significantly impacting its price. Think of it as the ease with which something can be turned into spendable money. High liquidity means it's easy to do. Low liquidity means it's difficult or comes with a cost. Let's start with a super liquid asset, cash itself. Obviously, you don't need to convert cash. It is cash. You can use it immediately. Checking accounts are also incredibly liquid. You can access that money almost instantly through ATMs, debit cards, or online transfers. Now let's move to something slightly less liquid, stocks. If you own shares of a popular company like Apple or Microsoft, you can usually sell them pretty quickly on the stock market. It might take a day or two for the funds to settle in your account, but generally, stocks are considered highly liquid. The key is there's a large and active market for them. Lots of buyers and sellers mean you can usually find someone willing to take your shares at a fair price. But what about something like a house? If you need cash quickly, selling a house isn't exactly a fast process. You have to find a buyer, negotiate a price, deal with inspections, and then go through the closing process. This can take weeks or even months, and you might have to lower the price if you're in a hurry, meaning you lose money. A house is considered a relatively illiquid asset. Let's look at a few more examples to really drive this home. A savings bond, less liquid than stocks. You can't just instantly sell it on an exchange. You have to wait for it to mature, or you might face penalties for early redemption. A collectible, like a rare baseball card, even less liquid. Finding a buyer willing to pay what you think it's worth can be tough, and it could take a long time. That antique furniture in your attic, probably pretty illiquid. Why does liquidity matter, especially for those of us in the US? Well, it's all about financial flexibility and being prepared for unexpected events. Imagine you suddenly have a large, unexpected medical bill. If most of your wealth is tied up in illiquid assets like real estate or collectibles, you might be forced to sell them quickly, potentially at a loss, just to cover the expense. Having liquid assets, cash, checking accounts, easily sellable stocks, gives you a financial cushion. It allows you to handle emergencies without disrupting your long-term financial goals. It also gives you the opportunity to take advantage of unexpected opportunities. Maybe a great investment comes along, or a limited-time sale. If you have cash readily available, you can act quickly. Liquidity is also crucial for businesses. A company needs enough cash on hand to pay its bills, salaries, and other expenses. If a business is short on cash, it may have to take on expensive debt or even declare bankruptcy. So, how do you improve your liquidity? It's about finding the right balance. You don't want to keep all your money in cash, because that means you're missing out on potential investment returns. But you also don't want to tie up all your wealth in illiquid assets. A good rule of thumb is to have 3 to 6 months worth of living expenses in easily accessible cash or cash equivalents. This provides a comfortable buffer for unexpected events. Consider a mix of savings accounts, money market accounts, and short-term, easily sellable investments. Diversification is key, too. Don't put all your eggs in one basket. Spread your investments across different asset classes, including stocks, bonds, and real estate. This can help you balance liquidity with potential returns. Think about your personal situation. What are your financial goals? What is your risk tolerance? How quickly might you need access to your money? The answers to these questions will help you determine the right level of liquidity for you. To recap, liquidity is the ease with which you can convert an asset into cash. High liquidity means it's easy. Low liquidity means it's difficult. It's important for handling emergencies, taking advantage of opportunities, and maintaining financial flexibility. Having a mix of liquid and illiquid assets and diversifying your investments is the key to finding the right balance. A good safety net is having 3-6 months of expenses in readily accessible funds. It's a fundamental concept for both personal and business finance, helping you navigate unexpected challenges and seize opportunities as they arise. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.